When you're considering purchasing a house hack property, one important thing to consider is whether or not it will cash flow. Today we'll talk about how important or not important cash flow is and whether or not you should purchase a house hack property that doesn't cash flow. Cash flow refers to the income generated after all expenses have been deducted. Not just the mortgage or just the mortgage and utilities, but everything, including property taxes, home insurance, maintenance, repairs, and even vacancy. So what's left over after you subtract the rent from all the expenses, that is your cash flow. And this is where people get a little confused on what cash flow is or what it should be. So cash flow is not really intended for you to live off of. It's there to act as cushion in all market conditions, whether the real estate market is up or whether it's down. If your property experiences a temporary decline in value during a downturn, positive cash flow ensures that you have the funds and the cushion to cover expenses and weather those fluctuations. And this is an example of why we account for vacancy. Having the stability and the cushion allows you to weather the market and hold on to your investment until the market recovers. And even then, you're still paying down your loan. Now, of course, cash flow is very important, but it shouldn't be the only metric you're looking at to evaluate whether or not you should purchase. It's just one of the positives that comes with owning rental property, especially house hacking. So here are some examples. You've got loan pay down. Every month, a portion of your payment goes towards paying down that principal on the loan. Over time, this reduces your loan balance, which builds equity, and your tenants are paying for it. I like to call it invisible cash flow. But loan pay down is a form of forced savings. Little by little, each payment increases your net worth and your equity in your property. Now, this isn't cash flow, obviously. In almost every loan type, except for a few, pay down your loan. But again, along with looking at if a property cash flows, it's important to look at your return on your equity too, not just cash flow. You've also got appreciation. Historically, home prices have increased in value over the long term. Now, appreciation is not guaranteed, but by owning a property in an area with strong growth potential, increases the likelihood of the value of that appreciating over time. Sometimes the appreciation of a property with little to no cash flow will net you a higher return when sold than the cash flow would generate over that time. Such as, let's say, a $200,000 property that cash flows $500 per month and sells for $250,000 over 10 years, which comes out to about $60,000 you've generated over those 10 years in cash flow on top of a $50,000 gain in value. This totals $110,000 versus say you buy a $200,000 property in a high growth area that breaks even and does not cash flow, but sells for $350,000 after 10 years. The property that didn't cash flow gave you a higher return in the long run than the property that paid you $500 per month in cash flow. The no cash flow property gave you $150,000 after 10 years, where the property that cash flowed only gave you $110,000. But yeah, ultimately it comes down to what you're looking for. Then we have tax benefits. Turning a primary residence into a rental property will offer various tax advantages once it's turned into a rental property. You can deduct expenses such as mortgage interest, property taxes, repairs and maintenance, and all of these will reduce your taxable income. Additionally, depreciation allows you to deduct a portion of the property's value every single year, which will even further lower your tax liability. With little to no cash flow, in theory, you may be able to deduct enough where you record a loss on paper, meaning not only will you not pay any taxes on any of the income that was generated, but you may pay less or even get a return after tax filing. Depends on how you purchase your house hack, personally or with an LLC or a business. Moving along here, owning a rental property adds diversification to your entire portfolio. House hacks and real estate investments in general have the potential to perform differently than other asset classes, like stocks or bonds, and this provides a hedge against market volatility. So whether or not you're cash flowing on your house hack, it provides a layer of stability if you own other assets. Stock market tanks, but your property remains stable or it rises in value. It offsets a little bit of that burn when you're looking at your overall portfolio of stocks, bonds, and real estate, no matter what the cash flow looks like. Lastly, you have rent increases. As you start to build up your rental portfolio, rental rates tend to increase over time with inflation. It's important to look into your local regulations when it comes to increasing rent. Different areas and different cities have different rules to follow on how high you're able to increase your rent every year. And this also applies if you decide to turn your house hack into an Airbnb or a short-term rental. So be sure to follow your local regulations for short-term rentals as well. But if you lock in a property that isn't cash flowing on day one, it may cash flow later down the road as rents rise over time. This is because a large majority of your monthly expenses is your mortgage, and most of your expenses for your house hacks are fixed. So your income or your rent kind of goes like this, where your expenses and your fixed rate mortgage stays like this. After all expenses are accounted for, and you're breaking even with the rental income to cover them, the monthly rent at some point will likely exceed your monthly total expenses. So the moral of the story here as we wrap this up, cash flow is clearly important to have. It's a great indicator to how strong and how safe that investment property is. The more cushion, the better. And that's why I think house hacking is the greatest way to buy an investment property. By house hacking, you will almost always get the highest cash flow possible on any given property. It's not guaranteed, it depends on your financing terms, but I often have trouble finding a house hack property with worse numbers than with investment financing. But cash flow isn't everything. Positive cash flow is preferred, obviously, but there are many other factors to consider when deciding to buy a house hack that in total could be more important or outweigh what the cash flow amount could be. As always, it depends on what you want your house hack portfolio to look like. All high cash flow, all high appreciation, or a mixture of both. It's important to nail down a plan and what your goals are with your house hack portfolio before you start looking. So that about wraps it up. Thank you guys so much for watching. If you found any value in this, please like, subscribe, share this with your roommate or your roommates, and we will see you guys next time.